Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Blue Bird Corporation quarterly report. Blue Bird Corporation offers a wide range of products and services that cater to the needs of school bus operators and fleets. The company's primary business involves designing, engineering, manufacturing, and selling school buses, including Type C, Type D, and specialty buses. These buses come with alternative power options such as propane, gasoline, compressed natural gas, electric, and diesel engines. In addition to its core product line, Blue Bird Corporation also provides replacement bus parts, which are essential for maintaining the longevity of their vehicles. The company offers extended warranties related to its products, providing customers with peace of mind and financial protection against potential repairs or replacements. Blue Bird Corporation sells its products through various channels, including direct sales to fleet operators, government agencies, and independent service centers. The company also maintains a network of dealers who sell its products through drop shipping arrangements. Furthermore, Blue Bird has a parts distribution center that ensures timely delivery of replacement parts to customers. Overall, Blue Bird Corporation's business model is centered around providing high-quality school buses and related services to meet the needs of its customers. By offering a range of products and services, the company has established itself as a leading player in the industry. Blue Bird Corporation's stock price has seen a significant increase of over 38% in the past year due to several positive news events related to its financial performance and strategic advancements. One key event was the company's fiscal Q1 2026 earnings beat, where it reported $1 per share in earnings, surpassing Wall Street expectations. This strong performance was attributed to higher pricing, operational efficiency gains, and robust order activity. Another significant factor contributing to the stock price surge is Blue Bird's record results for fiscal Q4 and full year 2025. The company achieved an adjusted EBITDA of $221 million with a 15% margin for fiscal 2025, which was an all-time record. Revenue reached $1.48 billion for the full fiscal year 2025, boosted by increased unit sales, favorable product mix, and effective pricing strategies. Additionally, Blue Bird's record results in fiscal Q3 2025 further contributed to investor confidence. The company reported net sales of $398 million and an adjusted EBITDA of $58.5 million, marking a new all-time quarterly record. The strong backlog of approximately 390 units at the end of the third quarter also boosted investor confidence. Overall, Blue Bird's financial performance and strategic advancements have driven its stock price increase in the past year. The company's leadership in alternative-powered buses, particularly electric vehicles, EVs, has been a significant factor in its success. With a strong backlog and record results, investors are optimistic about Blue Bird's future prospects, contributing to the surge in its stock price. Blue Bird Corporation maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Blue Bird Corporation trades at a lower price-to-earnings ratio of 13 times and a higher price-to-book ratio of 6.33 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 59% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of key financial metrics. Net sales are a significant driver, with a plus 6.1% increase from December 28, 2024 to December 27, 2025. This growth is particularly notable in the bus segment, where revenue increased by plus 6.8%. Within this segment, diesel buses saw a substantial plus 16.6% increase, while alternative power buses experienced a more modest plus 1.3% rise. Revenue growth rate also played a crucial role, with a 3.4% increase from September 27, 2025 to December 27, 2025. Conversely, accounts receivable decreased by $9,882, indicating improved cash flow management. Inventory levels increased by only $1.45 million, suggesting that the company is managing its inventory effectively. Product mix changes and seasonality also contributed to revenue growth. The bus customer and product mix changes resulted in a plus 6.8% increase, while the third and fourth quarters are historically the busiest periods for sales and production. Governmental grants, subsidies, and other incentives had an impact on buying decisions of school districts and fleet customers. However, pricing actions and tariffs also played a significant role in revenue growth or decline. Ongoing pricing actions, inflationary pressures, and tariffs increased cost of goods sold by $8.3 million, 3.3%. The cumulative bus price increases partially offset the increased procurement costs due to tariffs. Net income and profit margins have undergone significant changes over the past period. Initially, net income increased by $2,034, or 7.1%. Rising from $28,722 to $30,756. This trend continued with a 3.6% increase of $1,034,000. However, in some instances, there was no change in net income due to losses in both periods. The impact of the COVID-19 pandemic and supply chain disruptions led to a decrease in net income. Nevertheless, sales price increases helped mitigate the effects of rising purchase costs, resulting in an increase in net income. A notable example is the 6.9% increase from $28,722,000 to $30,756,000, primarily due to bus customer and product mix changes and cumulative bus price increases. Profit margins have also seen improvements. The gross profit margin increased from 19.2% to 21.4%, while the operating profit margin improved from 12.5% to 14.1%. Additionally, the adjusted EBITDA margin rose from 14.6% to 15%. These changes indicate a positive trend in net income and profit margins, driven by strategic customer and product mix changes and price increases. The company's financial performance is a notable aspect of its overall health. One key indicator of this is the generation of positive operating cash flow. This means that the company is able to generate more cash from its core operations than it spends on various activities, resulting in a net inflow of funds. According to the provided information, the company has consistently demonstrated positive operating cash flow over the past 2 years. In 2024, the company generated $26,410,000 in net cash provided by operating activities, and this figure increased to $36,579,000 in 2025. This significant increase indicates a strengthening of the company's financial position. The data confirms that the company is indeed generating positive operating cash flow, with clear evidence from multiple sources within the report. The positive trend suggests that the company is well positioned to continue its growth trajectory and meet its financial obligations. The company's debt level and interest expenses have undergone significant changes. In terms of debt level, the long-term debt has decreased by $1,170, indicating a reduction in financial obligations. Furthermore, term loan borrowings have also decreased from $90.3 million to $89.2 million. This decrease in debt level suggests that the company is managing its financial liabilities effectively. Regarding interest expenses, there has been a notable decline. The interest expense has decreased from $1.9 million to $1.6 million, representing a reduction of $349, or 4%. This decrease in interest expenses indicates that the company's financial obligations are becoming less costly, which can be attributed to various factors such as lower borrowing rates or reduced debt levels. Overall, these changes suggest that the company is making progress in managing its debt and associated costs. The company's financial performance varied across different segments and regions. On the positive side, the bus segment showed significant growth, with a 6.8% increase in net sales and a 23.7% rise in gross profit. The U.S. market also performed well, with an effective tax rate lower than the previous year. However, not all segments fared equally well. The parts segment experienced a decline in performance, with a 0.5% drop in net sales and a 1.8% decrease in gross profit. Furthermore, the Canadian market saw only a modest increase in net sales, which was largely due to a low base from the previous year. Overall, these results indicate that the company still has room for improvement in certain areas. Management's outlook on the company's strategy is centered around several key points. Firstly, they expect to recognize significant contract liabilities in fiscal years 2026 and 2027, totaling $8.9 million and $9.8 million respectively. This suggests that the company is anticipating a substantial increase in its financial obligations. In terms of investments, management has made equity investments in Microbird Holdings, Inc. and Clean Bus Solutions, LLC through the equity method of accounting. This indicates that the company is looking to expand its presence in the market by investing in related businesses. The company's pricing strategy will be focused on making its products attractive to customers. However, revenue growth is expected to be impacted by various factors such as property tax revenues, student enrollment, and buying patterns of major fleets. Management also acknowledges that seasonality has become unpredictable due to the COVID-19 pandemic, leading to increased inventory purchase costs due to inflation. Additionally, governmental grants and subsidies can influence the purchasing decisions of school districts and fleet customers. To evaluate performance, management uses non-GAAP financial measures such as adjusted EBITDA, adjusted EBITDA margin, and free cash flow. Finally, the company believes that its existing cash balances and expected cash flows will be sufficient to meet operating requirements for at least 12 months. The company has made strategic moves to enhance its operations through acquisitions and divestitures. In terms of acquisitions, the firm has taken a proactive approach by purchasing larger quantities of critical components with longer lead times. This move is likely aimed at mitigating potential supply chain disruptions and ensuring a steady flow of essential materials. On the other hand, the company has also engaged in divestitures to optimize its resources and generate revenue. One notable example is the sale of state emissions credits for $2.6 million during the first quarter of fiscal 2025. This transaction not only brought in significant revenue, but also allowed the company to free up resources that can be allocated towards more strategic initiatives. The company's financial strategy has been focused on returning value to its shareholders. One key aspect of this approach is the decision to buy back shares. This move allows the company to reduce the number of outstanding shares in circulation, thereby increasing the value of each remaining share. As stated in the company's annual report, page 17 explicitly confirms that the company has indeed bought back shares. This action demonstrates a commitment to enhancing shareholder value and reflects the company's confidence in its financial position. Concerns about inventory buildup or supply chain disruption are valid based on recent data. A backlog of 440 units as of December 28, 2024, and increasing again to 3,370 units by December 27, 2025, indicates a potential issue with inventory management. The increase in raw materials and finished goods inventories suggests that the company is stockpiling more products than usual. However, total inventories remained relatively stable, which may indicate some level of control over inventory buildup. Nevertheless, this could also be a sign of inefficiencies in the supply chain. Trade policies and tariffs have led to increased procurement costs for imported inventory, while ongoing supply chain disruptions have resulted in higher purchase costs for components. Additionally, significant increases in inventory purchase costs, including freight costs, due to supply chain disruptions further exacerbate the issue. These factors contribute to concerns about inventory buildup or supply chain disruption. That concludes the financial summary for Blue Bird Corporation. Feel free to comment below, and I will be happy to answer them when possible.